But right now we have a great company to present, and trading on both the ASX and the OTCQX. So if you're watching on the internet and you're in the US time space, MTXXY is the ticker code for the OTC markets. Now, without further ado, I'd like you to all put your hands together, please, and give a warm welcome to Peter Cook from MLX.
And it's my pleasure to be here to tell you the story of the next emerging diversified miner in Australia. Simplistically, it's a top 10 gold producer today. It's the largest tin producer in Australia and has a large number of advanced development and growth projects. Sits with a very strong fiscal position. It has a market capitalisation of about $370 million today, carries $70 million of cash on its balance sheet, and an enterprise value of about $310 million. It trades a monthly or 30-day average volume around 3.5 million shares per day, so it's quite liquid. In the last 6 months, post the consolidation and acquisition of our new gold assets, it started to trade like a gold stock. And you can see in the top little graph there our performance versus the gold index over the 6-month period. Being diversified, it also trades and has outperformed the mining and metals index. Our major shareholders, a common theme here, APAC Resources with 24%. China's largest nickel producer, the state-owned enterprise of Jinchuan Group, and some other smaller investors. By diversified, I point you to this slide. Globally significant position in tin, a globally significant position in nickel and cobalt, nearly 13 million ounces of gold resource, some copper, some lead and some zinc. And within that diversified portfolio, there's production, there's revenue, there's growth across different commodities. Moving on to the gold side of things, there's 4 gold projects within MLX. The 2 recently acquired from Alacer Gold, the Higginsville and the South Cal operations, the Central Murchison Gold Project and the Rover 1 Gold Project, which came about through the consolidation of Westgold Resources, a company which we'd been a major shareholder of for some 6 years. The Higginsville operations are located south of Kalgoorlie, or 35 k's north of that famous Norseman gold mining field. Our first full quarter in these mines had a good result, producing 42,000, or in excess of 42,000 ounces at a total cash cost of sales of $903 an ounce. The Higginsville operation, that's a picture of the process plant you can see there, contains a fairly modern 1.3 million tonne per annum plant, a resource of 1.5 million ounces, and is currently producing at around 150,000 ounces per annum. The South Cal operations, located on the Hampton Boulder Fault, about 30 kilometres south of Kalgoorlie, a prolific production area. The Jubilee process plant is a mine that's had 2 years of life for the last 25 years, which is testimony to the fact that in the goldfields, old mines don't die, they just get deeper. This is a 1.2 million tonne per annum processing plant, a 5.7 million ounce resource base, and modest production from here, also at a good total cash cost of sales. In fact, in our first full quarter operating these 2 mines, the company generated 51,300 ounces of gold and generated EBITDA of approximately $32 million. Moving on to the Central Murchison, one of our growth assets, an asset acquired through our consolidation of Westgold. The famous historic mining fields of Daydawn, containing the Great Fingal and the Golden Crown mines. The prolific production field of Big Bell, a mine that closed in 2003 when the gold price was $500 an ounce. A very large resource base, and in an area where there's significant carnage within the gold industry. We stand in this position without a processing plant, but with all the ore to run a processing plant for the next 10 or possibly 20 years. The key for development for this project is, as we've always done in the industry and our operating style, is to buy a large amount of capital infrastructure at a significant discount and not expose our shareholders to large capital risk or debt. So we're looking to move this to production in the ensuing year. Just a quick look at that, the Daydor mine, and running up the Great Fingal Dolerite, and you'll show you this prolific mine, the best mine in the Murchison. I say the best mine next to the Hill 50 mine. A mine that produced 1.2 million ounces at a grade of 20 grams per tonne. And just sitting in the hanging wall, the Golden Crown mine. Across the Big Bell, about 30 kilometres to the west, the Big Bell line of lode. Again, a prolific production area, produced 2.6 million ounces to date. A mine, a bulk mine, effectively mined to 600 vertical metres as a block cave, and 4 kilometres of strike barely touched. Our third gold asset, the Rover, an iron oxide copper gold project in the Northern Territory. We're keeping in line with our Northern Territory theme. The Rover is a new virgin discovery made, you'll see in the slide, under 300 metres of transported cover. The West Wiso Basin rocks, which David talks about in his phosphate presentation, sit unconformably above this. This is a virgin discovery. It's a copper, gold and bismuth discovery in terms of gold equivalents, and I only say this for the purpose of benchmark, about 7 million tonnes at 5.6 grams per tonne gold. It's a 1650 ounce per vertical metre ore system, and Westgold's previously announced scoping studies and pre-feas numbers suggest this can produce at around 60,000 ounces per annum at a cash cost of $580 per ounce after its credits. So within the gold, and what we're trying to do with our golds is this growth profile. Where we currently stand today in 2014, expecting to produce 170,000 ounces of gold from the Higginsville and South Cal operations. Bringing the Central Murchison on by the acquisition of a process plant, again without capital risk, to add another 100,000 ounces per annum in there. And then hoping to bring Rover on with that production by 2016, building a profile to 350,000 ounces per annum, with an expected all-in cost number on average sub $1,000 per ounce. So that's what we're doing in gold. I'm sorry for rushing through, but there's so many assets in this company, it's going to take me a long time to get through it. The base metal side. We are the only significant tin producer in Australia. We're one of the very few, if not the only, Western world publicly listed tin producer. You would have noticed, you may have read, that tin is a good performing metal on the LME. It's tipped by many to be the best performing metal in the current few years. We're a dominant player in tin in Australia. Our Renison mine, on a 100% basis, is a mine that's been going for 45 years. It's a very big mine. It's got a resource base of 11.5 million tonnes at 1.65% tin. Reserves of 5.5, approximately half that number. That's equating to 8 and 17 years of plant feed. This mine's probably in the best position it's ever been in its history since it was discovered today, following 3 years of aggressive exploration success. We own 50% of this mine in joint venture with China's state-owned enterprise company, the Yunnan Tin Group, which is the largest, most vertically integrated tin miner in the world. This mine is profitable for us today. It generates a cash flow at current tin prices around $35 million. And it has sustaining capex, our share of sustaining capex in this mine of about $10 million per year. There is significant upside in this at higher tin prices, and the surplus is exponential at higher prices. There's some minor assets at Mount Bischoff as well. I'll just take you and show you the size of this mine. This is an image of the magnetics at the Renison mine, and looking beneath the surface, this is a mine that's 2 kilometres wide and 2 kilometres across. It's a mine that has over 100,000 metres, 100 kilometres of 5 by 5 metre tunnels within it. It's an ore system that's open in all directions. And again, this is another mine that's had 5 years of life, like a lot of underground mines do, for the last 45 years. And I could probably say in 10 or 20 years' time, it's still going to have 5 or 10 years of life. To give you a feel for the dominance of this as a tin mine in Australia, This little plot here shows you a dot graph with grade on the left-hand side and tonnage on the right-hand side, showing you the historic production and the grade of the Renison mine. It is by far the most prolific mine, and of course nearly the second largest Australian-owned mine is this project's tailings dam. So it's currently in production. The capital is sunk, gives us a $300 million head start in the tin industry, and the margins are exponential at higher prices. And there is tin growth there also. There's the tailings retreatment project. For the last 40 years, the first 5 years, I think the tailings disappeared into the river system. For the last 40 years, the tailings have been stored on the surface, and the driver of the process for Renison has never been metallurgical recovery. The driver for Renison, without a downstream option to process this gold, has been producing a concentrate grade that is saleable on the international markets, which means a concentrate grade of between 50 and 55%. So fortunately for all that, the tailings have a much higher grade left in them, and we have a process to process these using more modern technology for concentration of these things, and building a tin fumer or a downstream process. So it's a finite project with a 10-year life at this point in time. Can add another 5,000 tonnes of tin production. Importantly, Renison is a polymetallic mine. It also contains a significant credit of copper. This also is in the tails dam. And with this processing method, we get a copper credit through here, and we tap copper out as a matte out of our smelting process, which gives us a good co-product credit, and certainly lowers the cash costs at this mine to be very, very, very attractive as the underground mine itself. The additional thing here is this will be the first time when this project's built that the capital infrastructure to process the other more difficult tin ore called stannite being the Latin word for tin, within Australia. Stannite is a copper iron tin sulphide. You know, tin ain't tin. There's tin oxide and there's stannite, and the problem with stannite, it only makes a low-grade tin concentrate. So you can never get it to an economic shipping situation. This will put in place the capital infrastructure to enable the processing of that ore and the copper that sits within it, and of course enable significant growth and long-term viability of this project, because most of the surrounding tin mines are fairly prolific with stannite. So the largest asset in the company, on the base metals side, our nickel cobalt iron project in the central Musgrave, is called Wingalina. We have a major land holding in this area. It is in the ore body. This ore body we're looking at in the picture here is within Western Australia, but it sits at the triple point between Western Australia, South Australia and the Northern Territory. It has a mining agreement which covers 18,000 square kilometres for development infrastructure. That mining agreement is in an Aboriginal reserve. It's a landmark agreement, and it not only covers the project itself but all the infrastructure routes to the project. It's a world-class project. Today it probably sits as the fourth largest undeveloped nickel project in the world. I tell you, it's not a laterite, it's a limonite. And a limonite's very different to a laterite when it comes to talking about processing nickel oxides. It's an iron ore deposit. It's 50% Fe2O3. A more adventurous marketing company would be marketing this a few years ago as an iron ore discovery. It's an ore that has a bulk density of 1.17, so it's physically like chalk. It goes about 1% nickel on average and 0.08% cobalt. I'll just take you in and show you this project. Again, magnetics, looking at the square, the line to the right hand side is the border. So it's 10 kilometres long. The ore body's been drilled over that strike length to a fairly good density, at least 80 by 20. You'll see it's a very low strip ratio deposit, 1 to 1 over the 40-year life, 0.5 to 1 strip ratio, and very, very simple. It's as wide as the Sydney Harbour Bridge, and we're on this theme of height. So in terms of scale, I'll show you the scale. It's as tall as the Eiffel Tower. The ore body is still open to the west and to the east. We have already here 40 years of mining reserve. and my chairman's not real keen on giving me money to spend it on exploration for year 40 to 50. It's done a full bankable feasibility study, which was done in 2009. It was an optimised feasibility study. It's a project that will produce 40,000 tonnes of nickel and 3,000 tonnes of cobalt, ranking up there as one of the largest cobalt producers in the world. An initial mine life of 40 years. Feasibility was done at an average nickel price of $20,000 per tonne and $45,000 per tonne of cobalt and a 0.85 exchange rate. Remember, this is 2009. These numbers have been updated for capital. The capital cost today is $2.5 billion, and on those metrics, this project had a $3.4 billion NPV. Recently, nearly a year ago now, we signed, just in time for the fall in the nickel price, an MOU with Samsung C&T, the large Korean conglomerate, to build this project, but to give MLX a 30% free carry to production. That agreement has still been sidelined. It's still live, and it's up for review. So what that deal means to this company, a free carried interest to commercial production. So we all get scared when we look at the big pile of $2.5 billion to jump over. I'm sure half the people around the table have drawn a big circle around $2.5 billion capital cost estimate already, which is the reality. But the deal to free carriers with majors in the nickel market is like these guys writing us a cheque for $750 million and handing it over and then snatching it back and say, that's your share. And for us, the annuity is a 30% interest of that free cash flow. An estimated average annual EBITDA of $500 million per year for 40 years. So it's a big annuity. I argue that it's probably the best and the largest asset in the company that gets the lowest value. An additional asset, a discovery made by accident. Not all geologists are as clinical and as clever as each other. We were looking for an iron oxide copper gold deposit in the Tennant Creek field and found by accident a lead zinc deposit. A modest lead zinc deposit that's just one of the assets that sits in the pool and is possibly capable of being developed or processed through a plant we intend to build at Rover. So some peer comparisons of MLX where we sit today. We have a new kid on the block from a gold perspective. It's hard to compare us against the other gold producers. So I'm presenting you two lines here. One is MLX as it stands with its tin and with its cash and with its other assets. Okay, and one with those stripped out, a nominal $100 million stripped out in value for the tin mine, the cash taken off. So lining us up in gold then as a gold producer against what we consider to be our gold peers, with numbers presented only last week from Bell Potter. So a company that's trading with an EV to EBITDA multiple of 2.1 times. Not 15 times like the alcohol companies in the world trade, but 2.1 times, hoping to go to 4.1 times, which is about where our average gold companies trade today. And in terms of the pool of assets, the enterprise value per ounce, which is not really a good measure, but makes some sense when it's lined up with the earnings and the enterprise value per earnings comparison, way under where our peers are trading. So in summary, I present you our scorecard. A diversified company with exposure shared across precious and base metals. Within the precious metals side with our gold assets, 2 producing mines, producing 170,000 ounces per annum. 2 growth assets ready for production. All the capital is sunk, drilled, ready to go. Tin production, that unique position in tin. You want exposure to tin as one of the hot commodities on the LME. We are one of the very few, if not the only, Western world publicly listed tin producers. We have growth within the tin industry. We have the development-ready major nickel deposit with Wingalina, a project that did a feasibility study when the iron ore price was pretty irrelevant. When the feasibility study was done, nickel and cobalt were the most valuable elements in the ore. Today it's nickel, iron and cobalt. It's a project that also precipitates 1.6 million tonnes of Fe at the back end of its plant every single year. So I turn that into Fe2O3. It's a project that, as a byproduct, produces 2.5 million tonnes of iron oxide a year. The company is in a strong financial position. It carries no debt. It has cash of $70 million. It's got strong cash flow. Our guidance this year has been for revenue of plus $300 million and EBITDA of plus $100 million. As I say, in the last quarter, the EBITDA was $38 million. We have a market capitalisation of 370, an enterprise value of 310, and that large portfolio of production and growth assets. So there's cash flow, there's diversification, there's growth, and there's upside. Can't ask for any more than that. You've quickly read that disclaimer, so I thank you very much and open the floor for questions.